In this video, I'm going over my top 6 stocks for the month of August 2022. So over the last month, I have researched hundreds of different companies, and this is my list of stocks I think should be on your watch list. I encourage you to watch until the end to get my full analysis on each of these companies. I'll go over key numbers, recent news, and why I expect them to grow in the long term. Now, the housing market has entered what might be a small recession, with some analysts calling it a potential repeat of the 2008 recession. Meanwhile, inflation rates have reached historic highs, and these price increases have compelled the Federal Reserve to raise interest rates. Of course, nobody fully knows what's going to happen next, but the best thing that you can do is just stay updated on the news and just dollar cost average into the market. Anyways, let's get started. So the first stock we're talking about today is American Express, stock ticker AXP. Amex is a multinational corporation well known for its payment card services. So right now, one share of AXP is trading at $154.02 with a 52-week low of $134.12 and a 52-week high of $199.55. If we take a look at the one-year price chart, you can see that 1 year ago, we were trading about $170 per share. We've seen some ups and some downs, as well as hitting an all-time high of about $200 a share. But since then, it has corrected a little bit with a small recovery recently. We have a market cap of $115.476 billion, a P ratio of 15.75, earnings per share of $9.78, and they do pay a small dividend of 1.35%. Yahoo Finance has it listed as near fair value. And if you take a look at the valuation measures, we can see that we have a 5-year expected PEG ratio of 1.33 and a price to book ratio of 4.91. The current profit margin is 15.86%, and we have a return on equity of 31.2%, which is very strong. This is on revenues of $47.96 billion in the last 12 months. And looking at their balance sheet, they have total cash of $25.19 billion with a strong current ratio of 1.63. Their current dividend payout ratio is 19.43%. Now, it's always interesting to see what analysts have to say. So on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts are rating Amex as a 2.3, meaning it is a buy. And the average analyst price target is $178.52, which is about 20% higher than the current price of $154.02. So a recent report revealed the change in credit card spending among American Express users, with rapid increases in spending for airlines, lodging, and restaurants. This is the first summer in years where the global market isn't significantly hindered by potential outbreaks. And the result is a consumer market hungry for travel and spending. Now, one of the biggest benefactors of this market boom will be credit card companies such as American Express. And we can see these benefits play out in the financials of the company. Amex recently announced its second quarter earnings, where the financial services company reported a 31% year-over-year increase in total revenues, net of interest expense. We also can't ignore the fact that the company's total network volume grew by a whopping 28% year-over-year, which indicates an increase in consumer usage and spending of their services. Stephen Squeri, the CEO of American Express, expressed his confidence in Amex's financial performance within a financial recession, if one was going to happen. He made it very clear that he didn't see a recession happening anytime soon. And Amex's earnings results really reflect confidence and durability in the company's ability to do business. Given the economic fears that many consumers have right now, it would be more than reasonable to turn to a financial services company that is highly faithful in its own business and the state of the market as a whole. Overall, I think that AXP is definitely worth checking out. The next stock on the list is UMH Properties, stock ticker UMH. UMH Properties is a public real estate investment trust with a portfolio of well over 20,000 developed home sites throughout 10 states in America. Here you guys can see that one share of UMH is trading at $21.31 with a 52-week low of $16.50 and a 52-week high of $27.50. Here we have the 1-year price chart showing a relatively stable price between $22.50 and $27. But a few months ago, we did see a pretty big correction in the price of the stock, followed by a swift recovery. They have a market cap of $1.156 billion, a P ratio of 106.55, which is very high, earnings per share of 20 cents, and they pay a great dividend of 3.75%. Looking at their valuation measures, we see a price to sales ratio of 5.59 and a price to book ratio of 3.75. Their profit margin is currently 21.45%. They have a return equity of 6.16%, and this is on revenues of $188.71 million in the last year. Looking at their balance sheet, we have total cash of $292.46 million and a current ratio of 22.36. Analysts right now are rating it as a 1.7, meaning it is a buy, and the average analyst price target is $26.50, which is just over 20% higher than the current price of $21.31. All right, so UMH Properties recently closed a deal acquiring yet another manufactured home community in Erie, Michigan, called Hidden Creek. Through the deal, UMH added another 351 developed home sites to its portfolio. These home sites take up nearly 90 acres and are over 60% occupied. So this recent acquisition shows that UMH still has the means and the mindset to grow and expand its portfolio portfolio and satisfy its investors. Another way of assessing the credibility of this REIT is by looking at who owns the stock. If we look at the distribution of shareholders, we can see that the vast majority of UMH shareholders are institutional investors, indicating that UMH has high credibility amongst the biggest investors in the market. This is definitely reassuring for retail investors like us, but some of you are probably wondering why I encourage investing in a real estate investment trust when there is a big question mark in the housing market right now. So first off, REITs tend to perform really well at the stage in the economic cycle, with this graph indicating a 1700% return from REITs since the late 80s. But another attractive feature of UMH is its dividend payments. At the beginning of July, UMH declared common and preferred dividends with a quarterly cash dividend of 20 cents per share payable to shareholders at the close of business on August 15th, 2022. This is a pleasant upgrade from its previous dividend of 19 cents per share, and the stable income that shareholders will receive through these dividend payments will be more than satisfying if a broader market recession were to happen. They'll be announcing their earnings on August 3rd, 2022, so be on the lookout for that. In the meantime, I'd definitely say that UMH is something to keep your eyes on, not just because it's a solid investment for the current circumstances, but because to me, it seems like a solid asset for the long run. All right, so we don't have a sponsor in today's video, but I wanted to give you guys a reminder to get your free stocks on Webull and Moomoo. They're two of my favorite stock trading platforms that are perfect for investors of all levels. Go to the description, click on those links, and you'll instantly get 6 to 10 free stocks once you deposit into your account. I encourage everyone investing to get your free money for opening an account. Links will be in the description, and this is a limited time offer, so get it before the deal expires at the end of the month. Again, use my link down below to start investing with your 6 to 10 free stocks. You literally have nothing to lose. All right, so next on the list is Darden Restaurants, stock ticker DRI. Darden Restaurants is an American restaurant company that's known for its ownership of restaurants such as Eddie V's and the Capitol Grill, as well as restaurant chains such as Olive Garden, Longhorn Steakhouse, Bahama Breeze, Seasons 52, Yard House, and Cheddar's Scratch Kitchen. So currently, one share of DRI is trading at $124.49 with a 52-week low of $110.96 and a 52-week high of $164.28. If we take a look at their one-year price chart, you can see that their price was hovering between $140 to $160, dropped down to under $120, saw another swift rise, and since then has corrected a little bit. They have a market cap of $15.43 billion, a PE ratio of 16.82, earnings per share of $7.40, and a decent dividend of 3.89%. Looking at their valuation measures, we see a 5-year expected PEG ratio of 1.9 and a price to book ratio of 7.02. They have a profit margin of 9.89% with a return equity of 38.1%. This is on revenues of $9.63 billion in the last 12 months. And taking a look at their balance sheet, they have total cash of $420.6 million and a current ratio of 0.64. The current payout ratio is 59.46%, which is okay. Right now, analysts are rating it as a 2.1, meaning it is a buy, and the average analyst price target is $137.60, which is just about 10% higher than the current price of $124.49. So Darden recently reported a very strong fourth quarter. If we compare its total revenues to the total revenues of other full-service competitors, including BJ's, The Cheesecake Factory, Red Robin, Texas Roadhouse, among many others, Darden actually blows all these restaurant chains out of the water. The restaurant company also boasted $2.6 billion in total sales, which is a 14.2% total sales growth, an 11.7% same restaurant sales growth, and a $2.24 diluted net earnings per share. And the reasons for Darden's success are pretty straightforward. The company is massive and still growing, and they know how to effectively control its margins in any market setting. Going back to the bar graph of Darden versus its competitors, we can see that its total revenue is more than double the total revenue of its biggest competitor. This is the result of owning 8 restaurant brands, with Olive Garden easily being the highest performing and most popular of its brands. And Darden is continuing to open more restaurants to this day, so it's obviously continuing to grow. Another advantageous strategy that Darden is implementing is avoiding the discounting of their food to ensure adaptability during an inflationary market. And the most important aspect of any business is having solid cash reserves. Darden is rich enough in cash to pay substantial dividends to its stockholders, currently at a very nice $1.21 per share. I think Darden has so much going for it, and it's definitely a stock worth following if you want to get exposed to the restaurant industry. Okay, next up is EOG Resources. EOG Resources is an American energy company that specializes in exploring hydrocarbons, the primary chemicals found in petroleum and gas. Right now, one share of EOG is trading at $111.22 with a 52-week low of $62.81 and a 52-week high of $147.99. So obviously a very big spread. Looking at their one-year price chart, you can see that 1 year ago, they were trading at about $70 per share, and it's pretty much continually risen for the past year. However, in the last month, we did see a pretty big correction to where it is right now. They have a market cap of $65.143 billion, a P ratio of 14.83, earnings per share of $7.50, and they also pay a good dividend of 2.7%. Looking at their valuation measures, we have a 5-year expected PEG ratio of 1.41 and a price to book ratio of 2.92. Their current profit margin is 19.46%, and they have a good return equity of 20.69%. In the last 12 months, they've hit revenues of $22.49 billion. They're carrying total cash of just over $4 billion right now, and they have a current ratio of 1.35. Their dividend payout ratio is 26.5%, which is pretty good. Analysts currently rate it as a 2, meaning it is a buy, and the average analyst price target is $145.34, which is just over 30% higher than the current price of $111.22. So with EOG, the beauty lies in its numbers. A very decent metric for assessing the health and potency of a company is its earnings per share. And over the past year, EOG's EPS has increased quite significantly, indicating a strong growth in profitability for the hydrocarbon company. Shareholders can expect to make substantial profits while invested in this company. And EOG is yet another dividend-paying business. The company currently pays out a quarterly dividend amount of 75 cents, or about a 2.77% yield. This ability to return cash to shareholders greatly benefits the total shareholder return of the company, because the metric of TSR takes into account both price appreciation of company stock as well as dividends paid. Analysts have calculated the company's TSR to be 53% over the past 1 year, which is quite a substantial return on investment. So yeah, I'd say that financially, EOG is quite solid. And if we think about the energy boom right now that has led to rising oil and gas prices, we can definitely expect a company like EOG Resources to benefit, with properties all throughout the US, parts of Canada, and within the Caribbean, as well as an investment interest in Australia. This broad influence is the reason why EOG Resources has maintained high returns for its stockholders. And very soon, investors can be potentially reminded of the company's profitability. On Thursday, August 4th, EOG Resources is scheduled to announce its earnings for the fiscal quarter that ended in June. So definitely be on the lookout for that. As far as numbers go, this is one that is doing great. So I encourage you to research it more if you are interested. Next up on our list is Dollar Tree, stock ticker DLTR. Dollar Tree is one of the most popular discount variety store chains in America, being a Fortune 500 company that operates over 15,000 stores throughout 48 US states as well as Canada. Right now, one share of Dollar Tree is trading at $165.36. with a 52-week low of $84.26 and a 52-week high of $177.19. So here's the 1-year price chart. We can see that 1 year ago, we were trading just about $100 a share, dropped down to $90 a share, and shot really high up all the way to its high of about $170. Since then, we did see a pretty big correction here, followed by a very swift recovery. They have a market cap of $37.133 billion, a P ratio of 24.87, and earnings per share of $6.65. They have a 5-year expected PEG ratio of 1.09 and a price to book ratio of 4.45. The profit margin is a little bit low. It's at 5.57%, but the return equity is great at 19.03%. This is on revenues of $26.74 billion in the last 12 months. They're currently carrying about $1.22 billion in total cash, and the current ratio is 1.46. They're currently rated as a 2.4, meaning it's between a buy and a hold, and the average analyst price target is $175.47, which is like 6 or 7% higher than the current price of $165.36. So inflation has been a widespread problem for retail businesses, and Dollar Tree is no exception. The company recently raised the value of its dollar items to $1.25, a strategy the company called breaking the buck. Instead, Dollar Tree claims to focus much harder on exceeding customer expectations by offering high-quality products and services. Given these higher prices, we should expect a slight decrease in profitability and sales for the business. But what we get instead is a 6.5% increase in consolidated net sales and overall net growth in same-store sales for the first fiscal quarter of 2022, reported at the end of May. And recently, Dollar Tree has been making changes to its executive leadership, with the most recent change being Bobby Aflatooni, the former executive VP and Chief Information Officer of the Howard Hughes Corporation, joining the company as Chief Information Officer. To me, this revision marks the company's sustained and unanimous effort to grow and improve its business. business, especially considering the fact that Alpha-Tuni's foreign positions greatly involve work in IT. Dollar Tree CEO Mike Witynski has explicitly said that these changes will bring fresh new perspectives that will help the company grow. In the grand scheme of things, Dollar Tree seems to be making a lot of the right moves. I think we can all agree that a huge change in the market is happening soon, with rising inflation, rising interest, and talks of a recession potentially happening. In these circumstances, Dollar Tree has conducted business that favors profits more than anything, which I think is a huge advantage in a market that's about to be bearish. So Dollar Tree plans to announce earnings on August 25th. So investors and analysts have another month to examine the performance of this company and analyze any sustained or novel profitabilities for the business. Until then, I definitely think that DLTR is a stock that is at the very least worth keeping on your watch list. All right, next on our list is Alphabet, stock ticker GOOG or GOOGL. Alphabet is an American multinational tech holding conglomerate that is most known for being the restructured form of Google, the largest and most popular search engine in the world. So right now, one share of Alphabet is trading at $116.32 with a 52-week low of $101.88 and a 52-week high of $151.55. Here's the one-year price chart. You can see that 1 year ago, we were trading between $135 and $150. And then starting in April of this year, we saw a pretty big decrease in the price to where it is right now. They have a market cap of $1.519 trillion, a PE ratio of 21.27, and earnings per share of $5.47. Looking at the valuation measures, we have a 5-year expected PEG ratio of 1.58 and a price to book ratio of 5.83. They have great profit margins at 25.89% with a return on equity of 29.22%, which is also very strong. The revenue in the last 12 months is $278.14 billion. They're carrying a gigantic amount of cash at $125 billion, and they have a current ratio of 2.81. Analysts really love Alphabet, and they're rating it as a 1.8, meaning it is a buy. And the average analyst price target is $147.86, which is just under 30% higher than the current price of $116.32. So as you guys may have heard, Google recently split their stock 20-1, meaning that an investor holding 1 share of Google now owns 20 Google shares. This is usually a very bullish sign for investors, as it means that the company is heavily thriving to the point where its shares have become no longer affordable. Splitting the stock reduces the share price while also retaining the market cap of the company. And it's very encouraging to see that Alphabet stocks are now much more attainable for retail investors. While the split may indicate strong numbers for the tech company, Alphabet's recent earnings report actually indicate a slow and slightly disappointing second fiscal quarter for the year. Alphabet announced a 13% growth in revenues year over year and a 28% growth in operating income. Now, understanding the durability and necessity of Google's platform, I highly doubt this quarter represents the end of Google and the end of Alphabet. Alphabet CFO Ruth Porat explained how Alphabet's astronomical year in 2021 set a very high bar for this year. It's also worth noting that a turbulent market may lie ahead, and that may make it difficult for many businesses, including the biggest ones, from thriving. But as the world becomes far more technological and far more reliant on information technology, I'm very confident that Google is a forever company, and I'm sure that many of you guys can agree with me. I think this slow quarter is an anomaly in the grand scheme of the business. For me, the best takeaway from this analysis is that Google just split its stock into 20 while also losing some value throughout the year due to a slow year so far. To me, it sounds like Alphabet is selling at a pretty big discount, and if history really does rhyme, now's a great time to get into Alphabet stock and hold it for a very long time. Anyways, those are my top 6 stocks for the month of August 2022. If you have not yet, definitely get your free stocks from Webull and Moomoo, as these deals will expire soon. As with all investing, make sure to do your own due diligence before investing in anything. This video is just an analysis of 6 different companies that I currently like. So yeah, don't buy anything just because it was in this video. I recommend doing at least 1 hour of research per company that you're interested in investing in. Anyways, if you enjoyed the video, make sure to hit that like button and also subscribe for more content just like this. I make a ton of videos about personal finance, investing, and entrepreneurship. Again, thank you so much for your time, and I'll see you in the next video. Peace.